All right, hello there. My name is Joe Dragoni. This is my session 9 assignment for the cost of capital analysis. I'm using WACC or WAC. So just to go into the assignment overview, just kind of know what we're working with here for our assignment. So we're going to calculate the weighted average cost of capital, or WAC, for Netflix in connection with the hypothetical $5 billion rather content investment decision. We must determine the current WAC, evaluate the impact of additional debt financing, assess project-specific versus firm-wide discount rates, compare Netflix cost of capital to industry peers as well. So just some of the parameters we were given for this assignment. We have $200 billion market capitalization, $14 billion book value, so the debt, $13 billion added debt, or $13 billion market value debt, rather. The equity beta being 1.3, the triple B plus bond rating with a 5.8% yield, 21% corporate tax rate, and the stock price currently $450. Some of the market conditions that were given is the risk-free rate being 4.5%, market risk premium, or the MRP, being 5.5%, and the media industry WAC range is 8 to 10% for the whole industry. So that'll be our industry benchmark. Then some strategic context as well. So some of the peers information that we're given is that the Disney capital structure is 70% equity and 30% debt with a WAC of 8.2%. And then Amazon Prime Video using Amazon corporate financing strategy and get with a WAC of 9.5%. And then Netflix is considering $3 billion additional debt issuance for a content investment. So now to use a driver framework to go over this assignment. So we'll start in the define and discover stage. So our primary tool for this is calculating the WAC, or the weighted average cost of capital. And for our goal, we want to calculate WAC and find the discount rate to evaluate a specific large-scale $5 billion content investment for Netflix. Netflix wants to look into a content investment strategy with the following inputs, those inputs being these parameters that we were given already at the beginning. Then the WAC will be compared to the hurdle rate in a capital budgeting analysis. So we'll have to look into CAPM and use some strategies from the past sessions as well. So we have to calculate the WAC for Netflix, the WAC after $3 billion added debt, the project-specific WAC being U.S. versus international projects, and how that might affect our financing strategy and our optimal capital structure. Then comparing to other companies, those being Disney and Amazon, and also recommending capital structure to use in this project. So this investment adds value if its expected returns exceed the cost of capital. This calculation requires us to find the cost of equity using CAPM model with the provided beta, risk-free rate, and market premium, and the after-tax cost of debt based on the BBB plus yield, as well as the current market value weights of its debt and equity. So just some of the other information we have. There's $3 billion in new debt as well that was introduced to us in the description, and you must analyze how the specific financing decision changes the capital structure. So with that, we'll need to calculate a new WAC, assuming the $3 billion debt is added to the balance sheet. So is the average rate the right rate? We must assess the project-specific risk versus the firm-wide risk, and is a $5 billion investment as risky as the average Netflix project? Also, is the firm-wide WAC the current hurdle rate, or should we adjust it to reflect the specific risk of this content slate? And then how does Netflix's cost of capital compare to its direct competitors? We are given the data for Disney, the 8.2% WAC, and the 9.5% WAC for Amazon. Those being Disney Plus and Amazon Prime Video. So just specifically looking at the streaming and media services. And this will provide crucial context for management about Netflix's relative financial efficiency. So now that we understand the direction which we want to take, with the D stage, we'll move down to the represent stage, where we kind of go over the calculations that we are going to look into. So capital structure analysis. So the WAC formula is the weight equity times the cost equity plus the weight debt times the cost of debt. So for that, we look at the WAC calculation being the equity over the total value times the cost of equity plus the debt over the total value times the cost of debt times 1 minus the tax rate, the corporate tax rate, which is little t here. So like we said already, K underscore E is the cost of equity, K underscore D is the cost of debt, E is equity, D is debt, and then V is the total firm value. So looking at the cost of equity here, the risk-free rate is 4.5%. The beta is 1.3 and the market risk premium is 5.5. So that gives us a 11.65% cost of equity. And then cost of debt as well as the tax-free rate, so kind of combining that to make our calculation easier and quicker. The corporate tax rate is 21%, so 1 minus 21 is 79. And then, or 1 minus 0.21 is 0.79. Then the pre-tax cost of debt is 5.8%. So 5.8% times 1 minus 0.21 is 4.58%. That's our cost of debt. So then looking at the capital values, the weight of the equity here is the 200 billion, which is the market value equity, and then over 213 billion, which is the total capital value. That would be 93.9%. And the weight of the debt is the 13 billion, which is the market value for debt over the total capital value of the investment, being 6.1%. So then our baseline WACC calculation will be 11.22% as we combine the weight of equity times the cost of equity plus the weight of the debt times the cost of debt, as well as the tax rate to get the 11.22%. So now looking at how this changes with the $3 billion in additional debt, the cost of equity and the cost of debt for our calculation will not change, but it's just the weights that will change. So with the $3 billion of new debt added, that makes our total capital value $216 billion. So 200 over 216 billion will be 92.59% for the weight of the equity, and then 16 billion, because we add the new debt to the existing market value debt, is 16 billion over the $216 billion, which gives us a weight of 7.41%. So then plugging those new numbers into our WACC calculation gives us 11.13%, which shows that bringing in some new debt into this large investment, even though it's just a little bit, will bring our WACC down just a little bit, which is a good thing. So $3 billion in additional debt lowers the WACC just slightly, but we can see that this is the effect of the tax shield, which is the benefit of adding more cheaper debt and having some more extra leverage in our company. So now looking at the U.S. versus international project-specific WACCs, the investments in international market typically have higher risks than the domestic market or the U.S. market. So we already calculated the U.S.-centric firm-wide WACC calculation, so we got to calculate the international WACC for comparison. So the risk-free rate is still 4.5%, and then we have a 2% premium that we have to add on to that to kind of consider how there's some extra risk investing in international markets. And then the beta and market risk premium will stay the same as well, as we see here. So our cost of equity international will be the 4.5, actually, yeah, our cost of equity for international will be the 4.5%, the risk-free rate plus the premium, plus the beta times the market risk premium, which gives us the 13.65% cost of equity. So then we plug that into the WACC formula to get our international WACC of 12.98%, because of the 92.59% times the 13.65% for the equity plus the 7.41% times the 4.58% for the cost of the debt. So now we have the two distinct hurdle rates for these two different types of projects, and just kind of being able to use those to compare as we move to the implement stage. So moving on to the implement stage of Driver, I had some assistance from Google Gemini to assist me in creating the Python code for the calculations of WACC as well as sensitivity analysis. We get the baseline WACC calculation as well as the WACC calculation adding the $3 billion debt as well. Then sensitivity analysis for market risk premium, or changing beta and changing market risk premium. So a couple of sensitivity analyses there. And then looking at the hurdle rate to get our recommendation for the capital investment strategy. And then also looking at the implementation of how investing in an international market or comparing the WACC for the international market will change our decision about whether or not we will invest or not. So just to show that this code works, I'll run it real quick. Give it a little run there. There we go. Just looking down through here, we've got the different functions to calculate the cost of equity, the cost of debt after the tax, then the WACC formula as well. As we can see here, that formula aligns with how we calculated it in the represent stage. And then the big function for sensitivity analysis, doing it for both the beta and the market risk premium, and then making the decision analysis for if we should invest in the project or whether or not our return will exceed our hurdle rate that is calculated in this analysis as well. And then as well as the baseline parameters that we were given to calculate the WACC, calculating the cost of equity and cost of debt as well. And then just looking down here at the implementing of the U.S. investment decision as well as the international investment decision. So like we said, got that to work already. So just looking at the results for the implement stage through the code, we see that the WACC calculation reflects the same numbers that we calculated above. Same thing for the WACC calculation, giving us the same WACC that we calculated after adding the $3 billion debt as well to our project, and how that will reflect in our WACC calculation. And then looking at the sensitivity analysis for when we varied beta and varied market risk premium and how that would change our WACC. We see this, we had an original beta of 1.3, and after tax, that gave us the WACC of 11.13%, which is very high compared to the industry benchmark that we were looking at, and just as high in general because of the risk and volatility involved with this company, since a beta of 1.3 shows risky and growth, which makes sense for a media technologically focused company like Netflix. So just kind of taking a look at the sensitivity analysis for beta, we can see that as beta goes down closer to that 1.0 market benchmark, that will decrease our WACC by a whole percentage point pretty much. Once we go to 1.1%, closer to the market, brings our WACC closer to just 10%, from 11 where we were, which is still relatively high, but at the same time it shows it's not as risky for our company. And then vice versa, as we increase the beta closer to the 1.8, 1.92 beta, that increases our WACC. So we can see a positive correlation with the weighted average cost of capital and the beta value. So as beta increases, so will WACC, and the other way around as well. And then looking down at the sensitivity analysis for the market risk premium, we sort of get the same idea there as we change the market risk premium by 0.04, 0.045, 0.5. That will increase our WACC as well. So as we increase the market risk premium by 0.05, 0.06, 0.065, that shifts the beta, or shifts the WACC rather, quite a bit. So like we said, our at the 5.5% market risk premium, we had the beta or the WACC of 11.13%, but as we go up to 6%, 6.5%, that'll start to really increase the WACC numbers by, it looks around 0.6 each time, 0.6% each time. So it just reflects that, as we increase the market risk premium by 0.5%, that will increase the WACC as well. So we also see a positive correlation between the market risk premium and the WACC through the sensitivity analysis. And then just looking at the implementation for our code, we saw that after calculating this WACC for this investment decision, the expected rate of return we will have is 13.5%. So because the expected return is 13.5%, which exceeds our hurdle rate of 13.13%, that was calculated here, then we would invest in the project. But looking at the international implementation, the international project decision, we calculated that the WACC of around the 12.98%, as we did above, but the hurdle rate here is 14.98% with that same expected rate of return of 13.5. So because of this, we would not invest in the international market because the return is less than our hurdle rate, so it would not be profitable. So just looking at this, it demonstrates why a single firm-wide WACC is insufficient, and that we need to sort of have a portfolio of different WACCs, look at divisional WACCs rather than one standard WACC, because it's always changing. There's always things that could be affecting our analysis, and could lead to non-profitability and risk for investors, and just not really reflecting the health of the company in general. So that was the implement stage. Now we can move down to the validate stage, where we'll compare our industry benchmarks and peer companies to Netflix. So like we talked about already, we have Disney, Disney Plus specifically, with a WACC of 8.2%, where they had 70% equity, 30% debt. Then Amazon Prime Video having the WACC of 9.5%. Then the media industry benchmark, the WACC was in between the 8 to 10% range, just in general. So we talked about already, our after-tax WACC for Netflix was 11.13%. So just to compare and validate our answers with these different companies, Disney had a beta of 1.55, but it's a diversified company. Overall, Disney stock in general includes just Disney Plus, as well as the Disney parks, the cruise lines, etc., which offset the risk of the streaming service for the entire brand. So because this, it's inherently sensitive to economic cycles and investor sentiment, leading to higher volatility. But we also see it uses a higher amount of cheaper debt at the 30% mark, whereas we're only using a lot less than that, because we invested, it's a $200 million market capitalization, but we're only using about $13 billion of debt there, so a lot less than 30%. So because of this, it helps Disney to lower their WACC value. And then for Amazon, Amazon's a huge company, also highly diversified. They have the selling platform, Amazon Web Services, Prime Video, which is what we were specifically looking at, and other services as well. So it's got a beta of 1.29, which is 0.01% or 0.01 lower of a beta than Netflix is, or at least the Netflix number we were given. And they're known for investing in technologies and new markets, which reflects the volatility here as well. But the financial risk varies as leverage falls under Amazon's corporate capital structure. So the same capital structure that defines the web services, the selling, the e-commerce business as well. And then Netflix relies all on its streaming service platform and technology advancements, so the beta reflects that. Because it's not a very diversified company. Their whole premise is providing television movies for people to watch, specifically on its streaming service. There's not anything more to that company. So the firm is more equity financed, which is a more expensive source of capital, which influences the WACC value. And then to look at the industry benchmark, being 8 to 10% for the related media technology industry, the numbers mostly fall around that region, except Netflix is about a whole percentage point above that. But this is due to the high equity weighting and the high beta combination. So then just to look at some other validation strategies that we could use, market value accuracy. Instead of what we're doing here, it might be better to use a 30-day or 60-day analysis, because stock prices are volatile over time and subject to change with events, which could establish a more stable and less biased market value of equity and debt, which might give us a more accurate WACC value. And we used a more static constant value, being that $200 billion market capitalization, and we assumed the new $3 billion in debt could be issued at the same 5.8% rate of the debt. But this could change and therefore have a different impact on the WACC. And then another good strategy we could use to validate our answers might be the beta stability check, using historical data of the beta of 1.3. Or we did use the beta of 1.3, which was the historical value for Netflix, but this is not the best idea because historical data values for beta might not reflect the future, which we talked about in the last section using CAPM and just looking at risk in general. The historical data for beta might not be the best to really shape our perception of the future. And then we're also taking on more debt, like $3 billion, and that increases the financial risk, which should in turn increase the equity beta. And like we said, we already looked at the sensitivity analysis up in the influence stage, but the 1.3 beta is likely at the low end of the true forward-looking risk, and if the beta increases, the company becomes more volatile, that could increase our WACC as well, and just increase our overall volatility and risk in general that investors will be looking at. So some other methods we could consider going farther, which is part evolve stage, but also part validation. Looking at a scenario analysis where we change multiple variables at once, compared to a sensitivity analysis where we're only changing one variable at a time, like the MRP or the beta. And then another more like computer programming based simulation we could do is a Monte Carlo simulation, where we run multiple thousands of simulations using a computer model to get more, streamlined average answers that are less biased and less susceptible to error in our calculation. And then the hurdle rate matrix, which is a project where the project is categorized by its risk relative to the core business using the risk matrix. So those are some other methods we consider to validate our answers and look and see if we could more accurately define our WAC and our other answers that we were determined here. So then moving into the evolve stage evolve stage here of driver, some applications of WAC usage and other concepts, and then some next steps as well. So DCF valuation, WAC, or the discounted cash flow valuation. WAC is the primary discount rate used to determine the price to pay for an acquisition. So this is a very important step in the process of, valuation of a firm or just cost optimization. And then WAC is used to measure the annual performance of the internal business units and executives in internal performance management. So this helps us to calculate economic value added. And then optimal capital structure WAC helps us to identify that and finding the structure that minimizes WAC, where we can get growth numbers and attract investors, but also not be too risky as well. So finding that balance where the tax shield still applies, but also minimizes the company risk perceived by shareholders. And then lastly, capital budgeting decisions, which we talked about earlier, where WAC can help deciding which long-term investments to make, like the $5 billion content slate, and whether or not that is a good investment to make. WAC is the discount rate that could be used to see if a project creates value, which is our net present value calculation, which is one of the overarching concepts we've been talking about this whole semester so far. And then if net present value is positive, then the project adds value to the company, and vice versa. And then we accept the project if the rate of return is greater than the hurdle rate, which we saw above in the implement stage. So the WAC of 11.13% and the project hurdle rate of 13.13% are not just one-time use numbers, but rather can be used to work through many parts of a company's corporate strategy, like Netflix or many other companies as well, maybe like Tesla, Google, Microsoft, etc. We can refresh this data with live market data to keep this analysis as accurate as possible. So not just performing this calculation one time, and then looking at a portfolio of WACs across multiple companies to look at divisional hurdle rates rather than just this one hurdle rate. Or just also looking at multiple countries at once, like we did with the US versus international project-specific WACs. And then lastly, moving on to the reflection stage, the last R of driver. Some of the key insights taken away from this WAC calculation, that WAC is not just a static figure, and it changes as we consider new financial decisions like the $3 billion additional debt. We saw that the $3 billion barely moves the WAC because the tax shield offsets the cost of equity increase. So another super interesting insight to take away from that. And then we must consider the context of the numbers when comparing to other numbers like Disney and Amazon in our project, specifically the context of the WAC numbers. So Netflix's 11.13% WAC shows riskier, low leverage company with a pure play, where they hedge everything on their streaming service, and its cost of capital must reflect that as compared to the 8.2% for Disney and 9.5% for Amazon, where they're much larger and diversified companies with other ventures. Like we said, the e-commerce business for Disney and like the Disney parks and cruises for Disney. So e-commerce for Amazon and the cruises and parks for Disney. And then WAC is sensitive to inputs like beta and market risk premium. So it's important to understand the key drivers. Like we saw in the sensitivity analysis, the increase in the beta and market risk premium across different companies might increase or will increase the WAC. And then between the US and international WACs, in the case of Netflix, we saw how international projects can come with a premium. that changes the WACC in our investment decision because the investors demand a premium for riskier cost decisions like that. And then location and associated currency, political, and economic risks is a critical driver of the investment decision. And then there are also some hidden risks that are exposed with the currency mismatch of different locational WACC values, like the dollar versus the euro or the rupee. If the rupee loses value in comparison to the US dollar, that might change the WACC and add some extra risk that investors might have to consider, or that they might not see initially without making these calculations. So the WACC is the minimum return a company must earn to justify its strategic choices in the eyes of the investors and must clear the hurdle rates to create value within the company, which is what Netflix has been able to do since the beginning. So this is another important thing to look at and take away from this analysis, which, it makes sense talking about some of the other concepts we've learned about this in this class, but still important thing to notice when doing these calculations. So then looking at our optimal strategy for the investment. So for looking at the two different project-specific WACCs, we saw that for the U.S. investment, we would invest in this project because the rate of return is over or is greater than the hurdle rate, and then we would not invest for the international investment, the $5 billion investment, since the hurdle rate is greater than the internal rate of return. And then just some last key things to note is that our analysis showed how adding debt lowered our WACC, so finding balance is key, like we saw with the apartment building example in class as well. And then for investment decisions, matching risk with rate. So instead of using a single firm-wide WACC for all decisions, the discount rate must match the risk of cash flows being evaluated. And then for investment and financing, the goal is to fund the firm's portfolio of projects at the lowest possible long-term combined cost, which is optimal WACC, which shows that the investment decisions and financing decisions that come with these calculations are linked. And then a constant WACC is an illusion because a portfolio of WACCs is reality, as seen with the U.S. versus the international WACC calculations. And then just the last thing, the calculation of the base WACC versus the content premium plus the country risk premium when calculating the international WACCs shows that the hurdle rate is a stack of risks and layered but not blended. So almost just like a stack of risks where they're not mixed together but kind of added on top of each other, which is it's pretty much like we saw, adding extra risk on top of the US WACC, not adding more there, because we really only just added the premium that the investors were looking for with their returns when investing in international markets. So yeah, that is the driver framework run through of the Session 9 assignment. Thank you for watching.